Joseph Brusuelas. Welcome, Joel. How are you?
Very good.
Can I call you Joe?
Please.
Joseph is a little longer. Okay, let's start with today. What's going on today in the market, especially with the initial claims and then Europe and then Japan, and we are seeing sharp declines. How should we read everything?
We've got a lot of big moves going on in the market today. I think the first thing we want to talk about is the announcement by the European Central Bank that it would purchase Portuguese and Irish debt, but not Spanish and Italian debt. And that had the unintended consequence of spooking global market participants, causing spreads on Spanish and Italian bonds to blow out, and also triggering a sell-off in U.S. equity, actually not just U.S. equity markets, global equity markets. So as we talk right now, markets are unwinding, and there's a real concern that the crisis in Europe is heading towards a tipping point.
How worse is that?
Well, it's sufficiently bad that it's got global implications. I think that at this point we have to admit that there's some global systemic risk if the euro would begin to unwind. You know, when Europe agreed on providing the EFSF, that's the European Financial Stability Fund, with an enormous amount of capital to help stabilize the situation, they really it was a half measure. It was moving towards what the Germans would call a transfer union, where they're going to be transferring tax resources to cover the debt responsibilities of the Greeks, the Irish, and the Portuguese. What the situation really calls for is to take a much larger step towards a fiscal union, where the German national balance sheet is leveraged up to cover responsibility basically for the European Union. That's politically difficult in Europe right now, and that's why we have these seemingly half measures that the market's generally not pleased with. So we are moving towards an endpoint of the crisis. It's hard to say when it's going to occur, but it will occur. What really bothers me is that we're seeing funding stress at the short end of the euro-dollar market, and you're seeing it in the big banks, especially the big European and French banks in particular. And that tells me that we are heading towards a crisis here.
Towards the crisis. We just left the debt ceiling crisis. Now it's the European crisis. We were expecting that. It wasn't gone anywhere.
That's right. No, that's
but
right.
we're seeing the implications right now, and the impacts actually is getting big. And the U.S. Let's go to the U.S. right now. In addition to this European crisis right now, we're also talking about a QE3 possibility, right? Is this possible, Joe?
Well, it's possible at this time. I wouldn't say it's probable in the immediate term, but we've had a massive revision, which has really changed economic reality over the past 6 days. Growth was revised downward. We had a massive downward revision in real income. It's income adjusted for inflation. And what that tells us is the U.S. consumer is in a much worse off position than was previously understood even a week ago. Now, we're setting up for the U.S. non-farm payroll report for July, Friday morning, here in the United States. One of the interesting things is expectations have been set so low that even if we meet the consensus expectation and you sum up the past 2 months, we will have only added roughly around 130,000 jobs.
Is that your expectation?
Over 90 days. Now, I'm expecting really about 75 to 85, but here's the important part. The U.S. economy needs to generate 150,000 jobs each month just to meet demographic changes. Really, to bring down the unemployment rate, which is at 9.2%, we should be adding 200 to 400,000 jobs a month. So we're setting up for another very difficult day in U.S. financial markets on Friday morning.
And it kind of proves Bernanke's. It doesn't prove actual Bernanke's point. It's like almost a contradictory, because for the last couple of weeks, we've been seeing the economic indicators going down and down. Every day we are facing a very, like you said, the GDP is pulled back. Even JP Morgan yesterday revised their growth numbers.
That's right. It's a very grim data flow, and that's what's triggering calls, at least among some market participants, for further support, whether it be from the fiscal side of the ledger or the Fed. I do think that a policy shift is likely, that in Washington on the fiscal side, at the Congress and the White House, I think they recognize that marginal tax rates are going to have to come down. There's going to have to be a broadening of the base to raise revenues. That means closing loopholes, getting rid of subsidies, changing in economically inefficient policies to spur investment and growth. Now, that may take a long time, so the Fed's watching this, and perhaps the Fed's thinking maybe we need to take other steps to support financial markets and overall economic activity. Now, I'm not sure that's going to end up resulting in additional asset purchases, but the Fed may change its communications policy to signal to the markets that the policy rates are likely to stay at zero effectively for a much longer period than is commonly thought.
Is that the only thing they will do? do?
No, they can. There's a number of steps that they can take. They could they can reduce interest rates on the $1.4 trillion in excess reserves sitting on the account at the Fed. They could even impose a small tax or negative interest rate to generate lending in order to spur economic activity. They could also cap yields. I think that the order of operations works is if we see some disinflation and deflation risks in the economy, they're likely to cap yields and impose a negative interest rate policy on excess reserves. If the economy is just growing at a very low rate, nothing's really happening, then they might think about telling the markets we're going to keep rates zero for a long period of time and perhaps purchasing more assets.
And that brings me to my last question. I know Moody's, Fitch, S&P told us that AAA downgrading is off the table for now. What we're seeing throughout the month and then upcoming months, maybe the economic picture is gloomy. Do you think there's a possibility of a downgrading still towards the end of the year?
I think it's a very simple proposition. If the Congress and the White House don't come to an agreement to reduce the fiscal path, or to alter the fiscal path that includes a net reduction of $4 trillion in spending, the U.S. credit rating will be downgraded. And the fact that we're growing slower than we thought, economic prospects are dim, that just adds the pressure. So if we don't see something in the next 60 to 90 days, I do expect Moody's, Fitch, or S&P, or all three will downgrade the United States.
60 to 90 days. We'll watch it. Thank you, Joe. Thank you for your valuable comments. I appreciate it.